What is stock market? Part 1, Introduction plus the basics. You hear about it all the time. Stocks going up, stocks going down, Wall Street, Dow Jones, S&P 500. But what actually is the stock market, and why does it matter to you? Let's break it down in the simplest way possible. Imagine the stock market as a giant marketplace. But instead of buying groceries or clothes, people are buying and selling ownership in companies. When you buy a stock, you're actually buying a small piece of a company. That piece is called a share. And owning a share means you're literally a part owner of that company, even if it's just a tiny piece. So if you own 1 share of Apple, congrats, you're a shareholder. If the company does well, your share could increase in value. If it does poorly, well, it can drop too. That's the risk and reward of investing. Part 2, how the stock market works. All right, so now we know the stock market is a place where people buy and sell ownership in companies, but where does all of this actually happen? There are actual places called stock exchanges, like the New York Stock Exchange and NASDAQ. These are platforms where stocks are listed and traded every single business day. But here's the thing. Most of the trading today doesn't happen face-to-face like it used to. It happens digitally through brokers and apps like Robinhood, Fidelity, or Charles Schwab. Let's say you want to buy a share of Tesla. You'd go to your brokerage app, search for the ticker symbol TSLA, and place a buy order. That order gets sent to the exchange where it matches with someone selling that stock. But how is the price of a stock decided? It's actually pretty simple. Supply and demand. If more people want to buy a stock, the price goes up. If more people are selling, the price goes down. And behind those price movements, it's everything from company news and earnings reports to interest rates, global events, and investor emotions. Part 3, how do people make money in the stock market? So now you know what the stock market is and how it works. But let's be honest, most people care about one thing. How do you actually make money from it? There are 2 main ways people make money in the stock market. 1, capital gains, and 2, dividends. Let's break these down. Capital gains happen when you buy a stock at one price and sell it later at a higher price. Simple, right? Buy low, sell high. But it's not always that easy. Stock prices can go up or down, and predicting them is part of the challenge. Now, the second way is through dividends. Some companies, especially big, stable ones, share their profits with shareholders in the form of regular payments called dividends. If you own dividend-paying stocks, you get paid just for holding them. It's like earning passive income. Some investors even build full portfolios focused just on dividend income. Others focus on growth stocks that they believe will rise in value over time. But here's the key. The stock market is not a get-rich-quick scheme. It takes time, patience, and a good strategy. Part 4. Who participates in the stock market? The stock market isn't just for Wall Street pros or billionaires. It's for everyone. And today, more people than ever are participating. Let's look at who's actually in the market. We're 1, retail investors. First, there are retail investors. That's everyday people like you and me. We invest through apps like Robinhood, Fidelity, E-Trade, or retirement accounts like a 401k or IRA. Retail investors are a growing force, especially with how easy mobile investing has become. Institutional investors. And there are institutional investors. These are the big players: pension funds, mutual funds, hedge funds, insurance companies. They manage billions, even trillions of dollars, and often influence entire markets. Next up, traders. These are people or firms that buy and sell stocks frequently, sometimes dozens or hundreds of times a day. They're not investing for the long term, they're looking for fast profits. 4, algorithms and bots. Yep, a lot of trading is done by bots now. High-frequency trading firms use super fast computers and complex algorithms to make millions of trades in milliseconds. So whether it's someone investing $50 a month or a fund moving billions in minutes, they all make up the ecosystem of the stock market. Part 5, is the stock market risky? Let's be real, the stock market can feel like a wild ride. So is it risky? The short answer, yes. But that doesn't mean it's dangerous if you understand how it works. Risk is a natural part of investing. Prices can go up or down. You can make money or lose money. That's why smart investors focus on managing risk, not avoiding it completely. Here's a big tip. The longer you stay invested, the more you reduce your risk. Historically, the US stock market has gone up over the long term, even with crashes and recessions in between. But short term, things can get bumpy. News headlines, elections, interest rates, global conflicts, all of these can cause sudden drops. So, how do you protect yourself? 1. Diversify. Don't put all your eggs in one basket. Spread your money across different sectors and companies. 2. Invest for the long term. Think years, not days. Let your investments grow over time. 3. Know your risk tolerance. Only invest what you're comfortable with. If you panic during every dip, you're probably investing too aggressively. 4. Keep learning. The more you understand, the less you fear the ups and downs. In the end, risk is part of the game, but so is reward. The key is to be informed and intentional with how you invest.